Okay. So guys, just from a recap point of view, what is an error? Omission, okay. Omission or misstatement, okay. All right. So in the case, okay, do you agree with me if it happens that, so in line with the concept of having an omission or a misstatement, if it happened that for whatever reason, um, we we had the information at the time, but we either didn't use the information or we used the information incorrectly. That's an error, right? Okay. What happens if we didn't have the information at the time? Is that an error? It is an omission, but is it an error? Would you treat it as an error for purpose of IS 8 if you didn't have the information at the time? Okay, let's have a look. My clicker is not working now. Okay, all right. So we're saying it's an omission from or misstatement in the financial statements. 100%. What the lady mentioned. Okay. First important principle, guys, is that it needs to be a material prior period error. Okay. So we looked already when we did the framework. We looked at what the definition of material is. For those of you in the audit space, you guys are comfortable with what the definition of material is. So, guys, I think what is important to get across here is not every error that you are going to have is going to be an error for purposes of IS 8. Okay. If it's not material, you just correct it in the current year. Now think about it. If you picked up a set of financial statements and you see a material or an error in the financial statements, what is going to be your impression of that company's finance team? Incompetent. What is going to be your impression of the audit team that signed off last year's financial statements? Also incompetent. Okay. So with so those of you in the audit space, you know when your audit firm wins an engagement, the first thing that they try and do is make the previous auditor look bad, so they try and find those errors to have those restatements. It's a business thing, guys. Okay. So first things, it looks really bad if you do have a prior period error. So that's why you don't adjust for all of them, just the material ones. If they are immaterial, you just correct it in the current year and move on. Okay. All right. So when we're looking at the definition of an error, we say it relates to one or more periods. Okay. So it could be an error in this year, but then my question is, does it classify as an error for us, for IS 8 purposes? No, because you just correct it now and you move on with life. Even if your year end is over, but you haven't issued those financials, you still get the opportunity to correct it, right? Okay. All right. A failure to use or misuse of reliable information. So it could have been the situation you had the information at the time when you made this judgment call, but for some other reason you misinterpreted it, misinterpreted that information, or you just ignored that information altogether, and that information was available when your financial statements were authorized for issue. Okay. So if you didn't have the information at the time that this transaction happened, let's say, I don't know, a good example would be measurement adjustments. Guys want to remind me what measurement adjustments are? Those of you who were here last week, okay, you get the opportunity to change the information within 12 months. Now, what they're saying here is that if you get that information, so you might not have had the information at the time that the transaction happened. Let's say, for example, it was a valuation. Okay, you didn't have the value yet. But if you got the valuation by the time the financial statements were authorized for issue, then you expected to correct it. Okay, because you haven't sent those financials out to the market yet. You still have the information, you can adjust it. Happy? Okay. So if it was even available at the time that your financials were authorized for issue and you still failed to use it, then we're talking error. Okay? If you misinterpreted facts or circumstances that existed at the time, or sometimes it's that you've just had mathematical errors or misapplication of policies, sometimes fraud, oversight. Okay. So those are generally the types of things that we're looking for to meet the definition of an error. Okay, so first important concept is the concept of materiality. We've covered that, and then you have to restate either your comparative amounts for your prior periods in which the error occurred. Okay, so from that already we see errors we record, we correct when backwards or forwards. If I tell you have to restate your comparatives, is it backwards or forwards? Backwards. Okay, so we go and correct the error, the period in which that error occurred. Okay, so high-level summary, guys, to make sure we've sunk in all the principles. Accounting policy, backwards or forwards? Backwards. One exception, which is paragraph 17, IS 38 and IS 16, revaluation and costs. So if you pick the revaluation model, that's the one exception that you use from there going forward. Okay? Counting estimates, forward or backwards? Forwards. Errors? Backwards. Okay, good stuff. All right. So you adjust the comparatives and the opening balances of your assets and liabilities for the earliest period presented. So again, in that example that we looked at earlier, your earliest period presented would have been the 2016 period. So you're going to adjust the opening balances of 2016. All right. Examples. During the annual year-end inventory count, a mistake was made in calculating the quantity of a certain inventory item. Error? Yes or no? Yes. Okay. The bookkeeper accidentally captured some invoices with the wrong amounts in the previous year. Error? Okay. Company X bought an asset 2 years ago. The VAT was incorrectly accounted for in the financial records. Error? Fraud was committed by director in the prior year. The fraud was detected in the current year. Error? Okay. Out of all of those errors, guys, which one is the one that might not be a prior period error? Because we only picked it up this year. Hey? Yeah, so in the case, so it depends on what the fraud would be. So let's say, for example, they created fake assets and instead of buying the assets, so let's say, for example, they took money out and they said that we bought all of these desks. So you should have all of these assets. Okay, but they've embezzled the cash. But on your fixed asset register, you're sitting with desks that don't exist. That's fraud. Okay. So it all depends on what they give you in the scenario. Okay. Number one, why? It happened at year end, so you still get the opportunity to correct it now. Okay. So guys, what's important is that you get errors, which are mistakes, and then you get prior period errors. IS 8 focuses on prior period errors because all the current period stuff you're able to adjust. Okay. So your disclosures, again, also quite similar to estimates and accounting policies. You don't repeat these in subsequent periods. So the period that you find the error in, that you corrected in, you disclose the nature of the error, okay? The amount of the correction for each line item. So quite similar type of disclosures to what we've seen. And then you'll adjust the earliest period that you've presented, the opening balance. Um, uh, unless, again, it's impracticable, in which case you'll give reasons as to why it's impracticable. Okay? Again, for your guys' purposes, you do not assume that unless the question tells you. Okay. So an example, during 2014, Company X discovered that prepayments of 400 made since 2012 had not been recognized in profit and loss as related expenses were incurred. The prepayment should have been recognized as follows. So they give you the breakdown of 2012, 2013, 2014, and they've told you in this particular case that the misstatement is material. So do we have a material prior period error? Yes. Okay, so talk to me, what do we actually do with that information? So do you agree with me? They've told us that the misstatement in total on prepayments is 400, and that 400 is broken up into the various years of 100 for 2012, 250 for 2013, and 50 for 2014. So in total, we get our 400 split over that period. Okay, what do we do? What's that? 2014 including the current year. So is that a prior period error? No. Okay. 2013, what do we do? Is that a prior period error? Yes. Okay. Do we go, so what do we do in that particular case? We go into the 2013 column of our financials and we correct, because we have to correct backwards, right? And then in addition to that, what does the standard say? They say we have to adjust the opening balance of the earliest period presented, which is when? We present 2013, so the opening balance of 2013 would have been the closing balance of 2012, right? So we'll then need to go and show the impact on the earliest period presented, which is the 100 for 2012. Comfortable? Mm-hmm. For 2013. Yeah, so you would have an adjustment to your opening balance as well as to your closing balance. Okay, so we have a set of financials here. You can see it's the draft for 2014. And that draft already has a profit of 500 and the comparative is a profit of 400. And then we've got a little statement of changes in equity where we then have the profits coming through there. And everything looks okay so far. But obviously this is the draft before the correction of the error. All right, so what do we do then? So we know for 2014 we had an adjustment of how much? 50. Okay. Does everyone understand what was the nature of this error? What's actually happened here? When they say that the prepaid expense hasn't been recorded, what's actually gone wrong? Okay? Prepaid expense is what? It's stuff that we've paid. It's an asset. It's stuff that you paid and you're supposed to release it to profit and loss as you incur those expenses. Okay? So in this particular case, they kept on paying the stuff, they kept on recording it to prepaid expenses, but they just never released to profit and loss. So what's our profit and loss at this point in time is overstated because we're missing expenses on there. Okay. So for 2014, our draft financials had a profit of 500, but we know that there's an error of 2014 for 50, right? So what do we expect our profit to be? 450. So if we go look at the solution, they've adjusted the expenses to include the 50, so we have a net profit of 450. Again, not a prior period error because we've picked it up now and we've corrected it now. Happy? Let's go look at 2013. 2013 has an expense of 250. So initially the draft financial statements had a profit of 400, but we know that it's missing the expense of 250, so the profit should actually be 150. All right, so if we go look at the revised restated financials, we have the expenses, which now includes the 250 error that we've made, and our net profit has been corrected to be 150. Okay. Now, because this is the earliest period that we've recorded in our statement of changes in equity, we've got the opening balance for 2013 of 14,000. And this is where we then put the notes relating to the correction of the prior period error. Because remember, you're adjusting before the earliest period that you present. So the only part that we have left, sorry, let me just go back. The only part that we haven't adjusted for yet is the 2012, this 100. So that comes through as a correction of your prior period error, 100 in retained earnings, which then corrects your retained earnings figure. And once that retained earnings figure is corrected, we then see that, and the profits have also been corrected, the profits then pull through correctly. Okay. %. Okay. So, I mean, I think in this example, they ignore tax, but you're 100% right. There would be deferred tax on prepayments. 23 cap H. Spoke about this last time. Okay. All right. All right. And then in your extracts for your notes, so you just have to explain during the year, They discovered that prepayments had not been recognized in profit and loss as they related as they were related to the expenses were incurred. The prepayments should have been recognized as expenses of 100 in 2012, 250 in 2013, 50 in 2014. Okay, so can you see what you've done there? You've adjusted the expense so the user doesn't actually see what the error is. So that's why it's necessary for you to then go explain for each period what was the related impact. And the financial statements the financial statements have been restated to correct this error, and the effect of the restatements is summarized below. Okay. And then you give the breakdown on your P&L. So then there's your deferred tax that you just asked about, your deferred tax and the impact on your profit, and then your on your financial position. You've obviously then reversed your retained your prepayments, because we've released those prepayments now to P&L, and the related deferred tax also has implications on that. And then this 72 is effectively your adjustment to retained earnings, but after tax. Okay. So the note itself is actually quite similar to what we would have seen in accounting policies and estimates, right? Because remember, we said we broke it down, all the elements of P&L that have been affected, including tax, all of the elements of financial position that have been affected, including tax. Okay. So guys, if they ask this in test 1, considering your other topics that you're getting tested on, or that are part of the scope of test 1, inventory seems to be quite a high possibility that if they do test a change in accounting policy error, something along those lines, will be integrated with inventory. Okay. Any questions? Okay. And then there's just a nice high-level summary. So when you guys are revising, there's just a nice mind map that you can use that summarizes all these particular principles. All right, guys. So there is a class example that I would like us to do, which is quite heavily integrated with the inventory as well. But I would like you guys to sit and to write that out. So let me just put this on pause. Okay. Right. So, and if I'm not mistaken, I think this question was possibly last year's test 1, maybe. Okay. So, guys, 60 minutes writing time. I'm gonna time you guys, and then I'll tell you when to put pens down. Okay. All right, guys. So before we start looking at the solution to the class example, let's chat. What did you guys think? Time management. Okay. Where do you feel like you're wasting time?
I think when I had to do the price points and stuff, when I had to do the T accounts, so I ended up leaving the morning going to number 2 because at least I knew number 2. But the B parts, I could do the notes and then put the steps and then do the calculations. And then when I went back to that.
Okay. All right. So the T accounts cost you some time. Okay. Okay. What else, guys? Who actually finished the question? 1, 2. Who got to at least who? Okay. Who cut off at the tax part? Okay. Right. Who didn't even get to tax? You didn't get to tax, and you as well also didn't get to the tax part of the question. Why? Okay, so you ran out of time. Okay. All right. Okay, guys, let's work through the question quickly, and then we'll hand out the solutions, and then we'll Bid our level ones goodbye. All right. So guys, overall, okay. So let's talk in terms of level of difficulty. So time was an issue. Okay, level of difficulty, it wasn't too bad. Okay. All right. So let's start at the top of the question. All right. So it starts by saying, let's actually go quickly to. So remember, from an exam technique point of view, guys, the first thing that you do is additional information. Okay. So it says they use the weighted average cost model calculated on an annual basis to determine the cost of inventory. Okay. So we're already narrowing down. If it's calculated on on an annual basis, it's almost the same like periodic. Okay. And we know a weighted average cost. And then they tell you here that the overhead costs of the beer or overhead costs are allocated on the liters of beer. Okay, so that helps us narrow down a little bit in terms of what they want us to do. If we go check the required, let's just before we dive into the information, let's just analyze that. So they're asking you to calculate the cost of the ale beer inventories as it would appear in the statement of financial position. Okay, so very similar example to what we did a little bit earlier. They want to know what's the value of this in the statements of financial position. Where are the easy marks in something like that? We know inventory is lower of cost NRV. Okay, so who left out the NRV? Okay, those are the easy marks, guys. Okay. All right. For the year ended 31st December 2018, your working should, with regard to each expenditure, indicate your reasons or your decision to either include or exclude. So that goes back to that lady's question this morning about is it necessary to put an explanation. In this particular case, they said, yes, put the explanation. If you don't have something, give a reason why. All right. So and then part B was prepare the change of accounting policy note to the financial statements for that particular year. Then they tell you that the disclosure of the amount relating to periods before 2018 is not required. Okay, and disclosure to earnings per share is not required. Okay, so pretty much that note that I gave you on the slides, the template, that's effectively what they're looking for. All right. So let's go and work through the question, the information. Okay, so it tells you you're a student studying your CTA, and as part of your qualifying final accounting examination, you assisted an audit firm with two independent client queries. Cool, important, ignore that. Okay. Right, so they tell you about this company, AleBrew, is a leading distributor of ale beer in South Africa and supplies a wide range of customers in the hospitality sector. Oh, great. Okay. AleBrew was incorporated in South Africa and is listed on the JSE since 1998, 31st December year end. Okay, so immediately we know timeline, 31st December. Okay, so based on the required, they've asked us specifically to do this for 20.18. Okay, so it gives us a reference point as to what period we're working with. Happy? All right. All right. AleBrew purchases beer from various breweries across South Africa. After the purchase, the beer is stored by AleBrew in bulk tanks at their facilities. The ale beer is then stored and measured in liters and then bottled and marketed in 50-liter casks. Okay. It's just some basic information we know. We know that they buy the stuff in bulk and they pack it into 50-liter casks. So it's actually a relatively simple business. Okay. All right. The current selling price is 50 Rand per liter. Okay. Which includes a deposit of 10% for returnable ale cask. What do we do that? What are they telling us there? Including the prices of the deposit. Okay, so can we include, if we analyze that 50 Rand, is the selling price really 50 Rand? What is the selling price? 45. Okay, so for NRV, it was quite a simple calculation, easy one mark, right? Okay. Thus, Ale Brew collects a deposit for each cask delivered to a customer and required to refund the deposit when the costs are returned by the customers. That's all cool. Um, Disruptions in the production of ale beer from the breweries during the summer months resulted in Ale Brew only selling and distributing 1.2 million liters of ale beer to customers in the 2018 financial year. The bottling facilities have a capacity of approximately 1 to 50 liters of beer per annum. So which one do we use? Do we use the 1 2 or the 1 to 50? Why? Remember, guys, remember the rule of significantly different is in the case where your actual production is significantly more. In this case, your actual production is less. What do we use? The 1250. Why? Because that's normal. They tell you over the past couple of years, we've been able to bottle approximately that volume. The reason why we've done lower in this year, it's because there was a strike somewhere, or there was disruptions in the market with the breweries. So there's something abnormal that has happened. So can you see they give you the message without actually using those words? The question is whether you're able to identify the message that they're trying to send to you. Okay. Happy? All right. Then they say the following expenses were incurred by Ale Brew during the 2018 financial year. Number one was depreciation of returnable casks. All right, and that's linked to note number one. And if we go read note number one, it says returnable costs in circulation are recorded as part of property, plant, and equipment at cost net accumulated depreciation. The returnable costs are not recognized upon sale of the goods. The costs of the costs are then depreciated over their residual lives over their estimated useful life. Okay, so they're telling you we've classified it as PPE. Okay, but is that a production cost or is it a selling cost? That depreciation. Okay. Is it necessary to get it into the location and condition necessary? Okay. All right. So you'll see the solution caters for both because it's debatable. My personal opinion is that you can't sell beer in plastic bags. You have to put it into something to get it into the form for sale. So I would say yes, it is part. But you could also then argue that, you know, it is possibly it's a packaging cost for selling. Okay. So the solution does cater for both answers. All right. Storage costs. So there's storage costs for the filled casks and for the ale beer in bulk tanks. Let's start with the costs. Is that can you add that to the cost of the inventory? Okay, 100%, because that is not necessary for the production phase. Agreed? All right. Storage tanks for the bulk tanks for the beer? Yes. Okay. Depreciation on vehicles, depreciation on tankers. Okay, why? Because the breweries are sending us this beer in bulk, those big bulk tanks, and it's necessary for us to get the product in. We have to incur that cost. It's part of the acquisition cost. Depreciation on delivery vehicles. No. Why? That's a selling cost. All right. Bottling overhead costs. Okay. Now, this will link quite similarly to how you felt about the casks, because if you felt that the cost was part of the production or getting it into the location condition necessary, you then would have argued that the bottling is also then part of that process. Okay? In the case where you felt that the costs weren't part of it, you might have also argued that the bottling isn't part of the cost because it's a selling cost. Okay, but the solution in that case also caters for both. Okay? Okay, so we've missed a couple of notes. On storage costs, they tell you that storage costs comprise of the cost to store the filled casks and the ale beer in tanks. We've discussed that already. So note number 2 is done. Note number 3 is on the depreciation of the vehicles. They tell you depreciation relates to tankers and delivery vehicles. The tankers transport the ale from the breweries to us, while the delivery vehicles transport the beer from us to our customers. So information given to you for you to be able to decide at what point, at what costs are relevant to get the product into the location and condition necessary. Okay. Then we have this information on raw material, note number 4, and big question mark. So we go look at note number 4, and it says, raw material comprises of ale beer sourced from the breweries. There are 300,000 liters of beer, ale beer in bulk tanks and full casks on hand on the 1st of January 2018. Okay. So based on the information that they've given you so far, so they gave us all of those. So in the case we were doing our tier counts, guys, they've given us all this information. Let me just add another page here. Yes, ma'am. See. See. Okay. Okay. So guys, based on your discussion on these costs that we have here at the bottom, there's certain costs that you might have argued that are included and certain costs that are maybe not included. So your tier counts on the WIP side would have had maybe some depreciation, it would have had storage. All of your answers will probably look different because the solution does cater for certain cases where it's yes or no, and they mark it both ways. Okay. We said what was the depreciation on the tankers. What else was on there? The casks, storage, bottling costs. Okay, so you would have included all of the related costs. What was bottling costs? 12.8 million. Okay, and then you might have had something there, you might not have had something there, depending on how you discussed that particular part of the question. All right, then they tell you raw material. Okay, so now that we've got all of that information sorted, raw material consists of the beer that we bought, and there was 300,000 liters of ale beer in bulk tanks and full casks on the 1st of January 2018. So that's effectively our opening stock. Okay. Now, in this particular case, they told you that it was 300,000 liters of bulk as well as what's in the tank. So they actually don't give you the split between raw materials and WIP. So, I mean, if you lump it all into one, you can have your opening stock there. We said 300,000 liters. And did they give us a value for that? At 10.5 million. So what was the value per liter? Okay. So I should have maybe laid this out a little better. Give me a sec. Okay, opening balances, we said 300,000. Price per unit, quantity total. So we said price per unit was 35. Quantity was 300K. And that gave us 10.5 million. Okay. All right. Purchases for the year, for the financial year, amounted to 1.4 million liters at 18 Rand. Okay. So we know that we made some purchases. 18 Rand. 1.4 million. So what's the total? 25.2 million. Happy? All right. A portion of the beer was lost in transit from the breweries to the delivery at the bottling facilities of the company through spillage and leakage. During 2018 of the 2018 financial year, their losses through spillage and leakage were 3%, which are regarded. Okay. So how much is our loss? Normal loss. So price per unit, quantity total, we lose 42,000 liters. Everyone happy? And then They had 458,000 liters of ale beer in bulk tanks and full casks on hand at the end of the year. So we know our closing stock is 458,000. So based on that information, how much did they sell? Okay, so we started off with 300,000. We bought another 1.4 million liters. We lost 42. So it's 300 plus 1.4 million. We lost 42, and we have 458 left. So it's 1.2 million liters that we've sold. Okay. Does that make sense? Yes, because in the question here, they told you that in this particular year, we sold 1.2 million liters. Yes, ma'am. Because so the information that they gave you in the question, they told you that the raw material that we had bought, as well as what was in the tanks being processed, was a total. They didn't give us the split. Not for this particular case. Yeah. So it's given to you in the question, but if you look at the information that we've collated, we had an opening balance of, let me use another color, 300K. We bought 1.4 million with 1.4 million liters. Out of that 1.4 that we bought, we lost 3%. So that's 42 that we've lost. And on hand at the end of the year, we have 458,000 liters. So the balancing figure is what we've sold, right? 1.2 million. Do you have a question? Sorted. Okay. So that's pretty much the end of part A. So the important part here was, guys, if you excluded a cost, you had to give an explanation, because the question told you that they wanted you to do that. So there's a lot of marks where there was a zero cost included, but you had to give a reason, and you actually got your mark for the reason. And yeah, so I'll give you guys a copy of the solution now, and you can have a look and compare what you had gotten to what the solution has. The easy mark at the end as well. Once you had your final number, you had to then compare your cost to NRV, which was that 45 Rand. Okay. Was this as time consuming as it took you, maybe? Okay. And I'm not saying that in an ugly way, guys. All I'm trying to tell you is it takes a lot of practice. And again, the purpose of these classes is that we can never teach you every possible scenario. What's important here is, guys, we teach you the principle, and you take that principle and you use it. They'll always throw a question at you that you've never seen before, or something that you've never seen before. But the question is, A, do you have the tool in your toolbox to be able to come up with a solution? Okay. So in this particular case, we spoke about the T accounts, and I know it's quite natural for students to be like, oh, split the raw materials and the finished goods. But at the end of the day, we give you the tools. The question throws you something different, you adapt. Okay. All right. There will always be something in your paper, guys, that you haven't seen before. Yes. You produce significantly more than your normal. Tell me why. You tell me why. Okay. Guys, think about if you're going to do an allocation on normal capacity, okay, and you produce less, what does that do? If you had to use your actual and you produce less, what happens? Okay? Your average is more. Okay? So let's throw some numbers to this scenario. Okay? So let's say, for example, you have a cost of 1 million, and you have production in scenario A of 100,000. Okay, and let's say that's normal. So your average per unit is how much? 10 Rand. Now let's go the scenario where you produce significantly less. Let's say for some odd reason something's gone terribly wrong and your actual is only 10,000 units. How much is your cost per unit? 100 Rand. Okay. Now if you're going to add this cost to the cost of your inventory, you agree with me, you're going to inflate your cost of your inventory by 90 bucks, right? Because if you had done it correctly, you would have used 10, but now you've used actuals, you get 100. So you inflated the cost. Chances are what's going to happen, your cost is sitting high, you're going to have an NRV issue. Because remember, you record stock at the lower of cost or NRV. Okay? So you've inflated your cost, which then means you're probably going to have a write-down, which means your consequence is exactly the same. Makes sense. The only reason why they then say is that if for you to, in the case where you produce more, so let's say, for example, let's change this scenario to say we've actually produced 500,000 units. So now our average is how much per unit? 2 Rand. In that case, what they're saying is rather use the 2 Rand, because if you use the 10, what you've actually done is you've inflated the value of your cost unnecessarily, because you would have included 10. So in the case where you produce more, it brings down your average price. They say, okay, fine, in that case, adjust. But if it's the other way around, don't do it because you're going to get hit with an NRV issue. You're going to get the same result. Make sense? Okay. There's another question there at the back. Oh, it's because in this particular question, they didn't actually give you the openings and all of that for WIP and raw material separately. They just gave it one lump sum. They said in total across everything, we have 300,000. It could be either in this case, because these guys are, if you look at this particular question, these guys are actually not processing. They're buying in bulk and they're packaging. So it could be. Okay. But at the end of the day, the principle remains that it's still stock. Okay. Yes, ma'am.
When do we do the whole conversion of the absorption per unit and then multiply by what? And when do we actually reduce the total and we just put it in as it is?
Variable or fixed. So if they give you a variable cost, then it's a cost per unit. You just plug it in as it is. If you have a fixed cost, then when we look at fixed costs is when we start using normal capacity to get an absorption rate.
But then if it's fixed and you're using the normal capacity, then why do you need the absorption rate?
For this exact same reason, because in the case your normal capacity is going to be different to your actual capacity. So in the case we use your normal capacity, so say if we had produced normally, it would cost us 10 Rand per unit. But our actuals, what has actually happened is that we've actually been bad this year, so it would have then come out to 100 Rand per unit. So they're saying still use your normal capacity. So you cost your inventory consistently. Does it make sense? Okay. Stew in a little bit. Okay. Anything else, guys? Okay. I think when we hand out the solutions, I'm almost confident that a lot of you would have passed this question, even though it doesn't feel like it. Okay. I think there was something, this question was out of 9, and there was like 20 available marks. Okay. Right, let's look at part B. Okay. So they ask you to prepare the change in accounting policy notes in the financial statements of Masia for the year ended 28 February 2019. So there we just need to have a timeline for purposes of reference. All right, as required by IS 8, and we've looked at the rest of the required. Yeah. Right, let's have a look at Masia. So Masia is listed on the JSE, on the industrial sector, and has a year end of 29 February 2018. Cool, nothing that we don't know already. The following information relates to Masia on the 28th of February 2019. Okay, profit before tax for the year important guys, before taking into account the information in notes 2 to 4 is as follows. So often what happens in a question, and I've seen this multiple times, where they'll tell you profit before tax doesn't include the changes in note 2 to 4, then they give you notes 1 until 8. And then students start adjusting the profit before tax for other things other than 2 to 4. Okay. So just be careful that if they give you this type of scenario, just make sure that you don't go adjust that profit for tax for anything outside of notes 2 and 4, or 2 until 4. All right, cool. So they give you the profit before tax, which is the 21 million and the 18 million. And then they tell you the depreciation expense of 4 million for the 2019 financial year does not include a change in estimate of 560,000. And they tell you as well that it is an increase in depreciation arising from a revision in the estimated useful lives of the vehicles. The revision of the useful lives was done after the profit before tax in note 1 was calculated. So even again, they remind you, they didn't even need to give you that. Okay? They tell you there that we first calculated this profit and then we didn't take into account this adjustment. Okay, so it's a second reminder in the question that we need to adjust for that. I feel like maybe they're just being nice. All right, the carrying amount and the tax base of the vehicles before the change is as follows. Okay, so they give you carrying amounts, tax bases. Okay, now in this particular part of the question, we're looking at part B. They've asked us to do the change in accounting policy note. Does this apply to us yet? No. All right. No vehicles were sold or purchased during the year. Perfect. All right, and again, after the profit in note 1 was calculated. So again, they're reminding you, guys, they are not going to do this, like in board, or I don't know why they've been that nice in this question, but they really want you to pass. Okay. The directors decided to change the accounting policy of the company in respect of valuation of inventories. Previously, the company valued the inventories at weighted average and then changed the policy to first in, first out, since it will result in more relevant and reliable information. Perfect. In line with what we studied a little bit earlier on today. All right. Where were we? The inventory values at the end of February based on the two methods of valuation were as follows. Okay, so they give you the totals. And they tell you under the old policy and under the new policy, this is what it is. Now, what do we do in this case? Okay, determine the differences. Why? Because we need to increase the values of our inventories. Okay, good starting point. What is the difference for 2019? Careful. Careful. How much? 77. Okay, 2018. 70, 2017. Okay. All right, and then they say assume that SARS will not reopen the previous years in the assessments to change the valuation method. So what does that mean? It's what? Deferred tax, temporary difference. So remember, they're not saying that SARS rejects the change. SARS just not opening last year's assessment for you to go change it. So in your accounting records, it's going to reflect in last year, where from SARS's point of view, you're going to reflect this year. Because SARS is not allowing you to go backdate your tax return. So what is that? Timing difference. Okay, so we expect some deferred tax there. All right. So tell me, does anyone want to give me an indication of what their accounting policy note looks like? Somebody want to come get the pen and come write it up for us? Who's got enough confidence? Am I pushing it? Probably. Okay. All right. No, it's fine. I'll go back into my cave. All All right, guys, talk to me. What does your solution look like? Okay, so you start with the title of the standard and you say there's been a change and there's going to be some write-up, say it provides more relevant and reliable information, and we changed from the one policy to the other. You give all of those words, and there's a total of 2 marks on the solution for that. And then one for communication skills, presentation, and layout. Okay, so let's say 3. Okay, then what do the actual numbers in the solution look like? Okay, so let's start. Remember a little bit earlier on when we discussed this on the slides, we said you have to disclose all the impacts on the various elements of the financial statements. Okay, so let's start with P&L. What do we expect to see on P&L? Okay, is it a decrease in cost of sales? Yes. And what links with that? Tax expense, and the net of those two is impact on profits. Okay, so tell me, what numbers do you guys have there for 2019? 7,600. Tell me, how did you get your 7,600? Okay. All right, 2019 minus 2018. Okay, so guys, remember cost of sales is calculated by looking at your opening, purchases, and closing. Minus your closing. Everyone happy? So do you agree with me, for 2019, our opening balance had to increase with 70, and our closing had to increase with 77,600. So what does that mean? Net impact. It's an overall decrease of 7,600. What's the tax on that? 2,128. Happy? What's the impact on your inventory? Or let's talk about financial position. What lines on the financial position do we expect to be impacted by this? We have retained earnings. What else? Inventory and deferred tax. Not SARS, deferred tax. Yes, you're 100% right. SARS for 2019, deferred tax for 2018. Okay. All right. So what is the value on our 2019 numbers for inventory? 77,600. Okay. Tax on that? 77,600. Tax 21,728. And then for and the net effect, how much? 872. Perfect. Okay, for 2018, 70. And our tax is what? Is it deferred or current? Deferred, how much? Impact? Okay. Not too bad, hey guys? All right, so that's pretty much in addition to the write-up that you need to do, or the blurb that you need to give at the top. That's pretty much the numbers that you're going to see on the note. Then part C of the required, calculate the profit or loss. Okay. Now, guys, it's you can see from the allocated marks. So anything longer than 3 minutes is unacceptable. Okay. Even if you don't have it, move on. Okay. There's other stuff that you can get. Okay. So tell me, what did we do on our profit before tax? Okay. What was our starting point? Profit. Well, they gave you the profit before tax, so we use that as a starting point, and then what? Okay, how much? Then what else? Hey? The inventory change. So what's the impact there? 7,600. Careful. No, but you talk about the revaluation on land. In this particular case, they've asked you for, what is the required asked you for? Profit before tax. Okay? Your revaluation goes to where? OCI. So that's outside of this required. What number, what other number are we missing? And this is probably going to get somebody immunity for the rest of today. If somebody can tell me what other number are we missing on calculating profit before tax. Okay, so we have donations. Explain. Okay, so here, guys, you can see on the profit, they tell you included in profit before tax are. Okay, they say dividends received. Does dividends received belong in profit before tax? Yes, so it can stay there. That's cool, no problem. All right, foreign income. After the deduction of 10,000 rand, 10,000 rand in foreign taxes, that is not taxable in South Africa. Hey? Why? Okay, you can see that they've netted off this value, the 10,000 tax. So in actual fact, what is our revenue? It's actually 60. We only received 50 because wherever they paid us from, it's a foreign tax. They deducted 10,000, but our actual revenue is 60. Okay, that was the loss adjustment on your profit before tax. A bit of a sneaky one. What's that? I think there's halves all over the place. Let me actually check for you now. Yeah, there's halves. It depends on how they give you the information. So in this particular case, they said your foreign income was after the deduction of the 10,000 foreign taxes. So remember, when we did deferred tax, where does tax go? So remember we had spoken about within that tax expense line. In that tax expense, there was foreign taxes. So in your revenue is going to be the gross, and then you take out tax separately in the tax line. They netted the two off together. Okay. If this question asked you for profit after tax, you wouldn't make an adjustment here because the impact would have been the same on profit after tax, but they're asking for profit before tax. Make sense? Okay. If you missed that foreign tax one, guys, it's the only time I'd be willing to forgive. Okay. All right. Prepare the income tax expense note. Okay, now I know it's been a while since we've done deferred tax, but I know you guys have gone home and you've studied and you've worked through all your materials, so we're more than ready to take this on. Okay. All right. Where were we? Prepare the income tax expense note. What does that income tax expense note look like? Which is what? Current tax, deferred tax, foreign tax, all of those things. Okay, you've been studying. Good job. All right, awesome. Okay, so that's effectively what they're looking for there. And then just, they say, please note, the movement in temporary differences in the tax calculation must be calculated using the statement of financial position method. Oh, shit. I can't say it on the screen, on the speaker because of the online guys. I'm so glad. Then it makes me feel better. Thanks. All right. And the tax expense reconciliation should be done in accordance with IAS 12. Comparatives are not required. Okay. So guys, obviously, if they give you that information, the solution is only going to cater for that scenario. Okay. It was also quite obvious because in the question they gave you carrying amounts and tax bases. Okay. So already there you could see that they're pushing you in a certain direction. Okay. So talk to me. What do your calculations look like? Let's start with the tax calculations. Your profit before tax. Okay, in that particular case, because they asked you to calculate profit before tax in B2, if you used your number, you would have gotten what it was. The principle is that you had adjusted your deferred tax for your profit before tax for those. So you start with that. Then what else would you have adjusted in your tax calculation? Sure. Okay. Someone? Okay, like what? In this particular case. Dividends received, what else? Foreign income. Why? Because they told you in this question you don't pay tax on. You're not going to be taxed in South Africa on this. What else? Okay, donations. Okay. Anything else? That was pretty much it, eh? And then in addition to that, we then have to bring in the other components. So that was current tax. Then we have deferred tax. Mm-mm. Your provisional payment is a financial position transaction. So here they're asking for the profit and loss. It's the expense, the actual expense that they're asking for. Okay, what does our deferred tax calculation look like, guys? So if in the case where they've specifically told you you must use the statement of financial position method, from the time that we did deferred tax, what do we know about that? You have to do the 2 years. Why? The movement in those two is what's going to give you your P&L deferred tax. Happy? Okay. So our carrying amounts for the prior year, what assets would we have had? Where's that question? Okay. So we have some fixed assets for the prior year. Was there any adjustment in those numbers? Okay. And what else did we also have in the prior year? Inventory. Okay. Would our carrying amount have equal tax base in the prior year? No, because SARS didn't allow us to go and adjust those previous year numbers. Happy? Okay. What do we have in the current year? What's that? Okay, so we know from, because in this part of the question they told us before taking into account the change in the estimates, these were these were the carrying amounts and tax bases. So we know that we have to remove 560 for the change in estimate to our carrying amount, right? Okay. Does that change our tax base? Okay. What other assets did we have in 2019 that might have given rise to some deferred tax? Inventory? 100%. Your inventory is already sitting in the profit before tax. Okay, what's the other one? Land. Okay. So let's go have a look at that piece of the information. Okay. We acquired land for 2 million on the 10th of March. Now I can't even read my own stuff. Have you guys taken down these notes? Can I just remove that? All right. All right. So they acquired land for 2 million on the 10th of March 2018. Land is measured at on the cost model in terms of IAS 16. It is the policy of the company to subsequently measure land according to the revaluation model. The fair value on the 28th of Feb 2019 was 3 million. Okay. Now let's try and jog your memory. When we did deferred tax, What did we say about these scenarios? You have to first look at management. Okay. Can you ever use land? So how are you planning to recover the benefit of the future economic benefits of land? Through sale, which means what tax rate? CGT. Fantastic. Okay. So we have a million rand revaluation, correct? Okay, we're going to raise deferred tax on that. At what rate? CGT, 28% times 80%. Happy? Okay. Now, question for you guys. Why would we have included land knowing that the revaluation goes to OCI? Why would we have even included land in the deferred tax calculation? It will. It will.
So therefore you want to give a true reflection as much as you the revaluation to 1 million rand. The total equity of the equity should only be 1 million rand minus tax.
Less tax. Okay, fine. Any other thoughts? Remember, guys, when we did deferred tax, and I can even still see the slide in my mind. There's tax expense. Is there a problem with my slide?
No, you remember the fact because you did them for us.
Yeah, that's true. That's true. They are good slides. They are good slides. Okay. So remember, you get tax expense, and remember, there's the two blocks in between that we said was made up of current tax and deferred tax. And remember, we then said deferred tax is the movement between your opening and your closing. Okay. And then I asked you, is that true? And some people said yes, and some people said no. And then we unpacked to say when you have deferred tax in the statement of financial position, you'd have the deferred tax for P&L as well as OCI, where in tax expense you might only have P&L or you might only have OCI, so you need to split it. Remember this. Is it all coming back to you? No. Okay, I tried. Okay, guys. So pretty much in this particular question, they are asking you for tax expense, so total tax expense. So they're talking about P&L as well as OCI. If they just said tax expense for P&L, the land would have had no impact on us here. In which case, if we're going to do our financial position method, you would literally just look at your deferred tax for your P&L elements on your financial position. Okay. It was 1 mark though, if you skewed that. Okay. So guys, based on just the discussion that we have, how do you guys feel? Are you feeling a little bit more confident? Okay, we are getting there. I feel like we definitely made progress from 2 weeks ago. So I'm going to give you guys the solutions I do want to market, and then level ones, if you do want to stay, you are more than welcome to stay. But as soon as you guys are done marking, if you do want to go, you're more than welcome. And then we'll probably start with the level twos in about, let's say, 10 minutes to mark, 10-minute breaks, about 20 past 4. Okay. I keep on using this time, but knowing that this time is wrong, so it's not. It will be about 5 past 4 in real time. Okay.